Okay, good morning, traders. Welcome to this live intraday strategy webinar on SB Trade Desk. Today is Tuesday, December 8th. Good to be with you guys this morning. Hey, Ted, Pete, Jay, great to see you guys. Lots to look at, not much I'm operating off. And that's just, it might be trigger shy on my point, but a lot of interesting moves here with the dollar breakdown, okay? We do have some event risk on tap tomorrow with the BOC specifically, and heading to the following day, the ECB, keeping both of those in view. But on the menu for today, we'll hit DXY, Euro, Sterling, Kiwi, dollar CAD, SPX with a small, slow crawl higher, dollar yen, and gold. Gold is going to make a move over the next couple of days, in my opinion, and it's pretty much determinant on how this rally reacts at this level today. So we'll take a look at the gold levels as well. As always, guys, feel free to throw out any questions or trade setups you want to throw out or take a look at, but let's dive right in. So as it stands, here's what the DXY looked like earlier in the week. You know, we noted that weekly break, massive break, 91.92, 92.28 is the key zone. You have a multi-year slope trend support that broke. Here's the accelerated drop. We've already taken out 91.01. Next downside level is the 88.6. If we take another parallel of that slope and extend it off that low, it ends up being this same slope, guys, this pitchfork off the highs from 2016 and this year. So the gradient seems phenomenal. Okay, it seems phenomenal. The only thing is, at this juncture, there leaves a little room for another drop, maybe a test of 89.93 before a larger turn in the dollar. Here's what it looks like on the daily chart. Not really much to write home about. I know all of you are usually in that daily FX webinar on Monday. Same thing. I felt yesterday, you know, like I don't really know what to do here. I would like for this to have been a more prominent support structure, giving us more justification, more validation, more conviction on a turn here. But I just don't have it. You know what I mean? Near-term resistance 91 now. Bearish inval, we'll go ahead and move that down to the monthly open, which converges on those 2020. I guess this is just the September low. Let me change that. Intraday looks like this. Weekly OR is setting up pretty nice. Again, it's not really between any major levels. Let me show you this on the 240 minutes to give you a broader picture. There's that slope we've been tracking. Not bad, but again, you know, we're not at support. I'm not at a lateral level. I can't, you know, try to justify trying to fight this for a move higher just yet. So the ideal scenario, excuse me, ideal scenario is you see that final washout. Okay, whether it's into slope or whether it's into that longer term 88.6, a little bit deeper 89.90, but you get the picture. That's kind of the idea here. Let me go ahead and add this retracement. Questions on DXY? As far as event risk is concerned, we're pretty limited until we get into Thursday. We do have core inflation rate out of the United States. You know, a lot of people are talking about being a big hitter this week. I don't see it. 1.6 expected clip year on year, pretty much in line with where we are. So that's DXY. So where's the juicy trades? Well, unfortunately for me, it's still not on Euro, although Euro is something that I'm watching. Let's take it from the top down. Here's Euro as it looked last night. Okay, let me just show you what the weekly chart looks like. The main level here that we've been talking about is 21.45. It's a 786 of the 2018 drop. We're still holding that on a closed basis as resistance on a weekly chart. So divergence into the high, you can go ahead and trigger that, check mark that as well, right? Pretty identifiable, readily identifiable divergence into the high. Not justification to fight it though, but the level to watch, right? I'll also just indicate those swing lows that we made back here in February was a nice little pivot that we were looking at from 2018. Long story short, you know the levels. Bullish inval, or at least the false breakout, would be a move back below 120. It's a long ways from where we are. strength beyond this level, and it's pretty much resumption. You got slope near, I quoted 2250, but I think it's a little bit higher at this point. And then obviously the confluence at 2337. So longer term, from 1,000 feet up, the breakout materialized for sure. Okay, this is the first sort of level. Going to get a kickback. That would be the level to watch or be concerned about. I'll also highlight just those highs that we made back here. So a decent pivot zone in price. Here's what euro looks like on the daily chart. So again, excuse me, guys, too many meetings, losing my voice already. This is what it looks like on the daily chart. You know what I'm saying? Is that a raised ceiling? I ask myself. A turn right ahead of resistance on the exhaustion trade. Obviously, on a daily close basis, we continue to hold, right? That 786 retracement as resistance. Look, as far as euro is concerned, I think the daily close is going to be the tell. A daily close above 2145 marks resumption. Then you're looking for that scratch into that confluence region near 2230s, 2220s. Initial support, obviously 2092 is still going to be that region that we were looking back at. Nice little pivot high from back here in 2017. Obviously 20, as I said, is bullish inval at this point. So if you make it back below the big figure, that's going to necessitate a break below this confluence, the former swing highs from September, slope support off of the November low, the 75% parallel, all are right there. So while the near-term momentum looks a little dicey, the broader picture as far as the levels are concerned are really, really clean. Okay. I'll also bring your attention to RSI. I brought this up yesterday in the webinar. I want you guys to keep watching this. You know, that's as fake out as it gets, right? I think RSI closed like literally at 70 yesterday. So not the exhaustion, you know, pump back below 70 that you want to see to try to fight this, like here, at least for a near-term decline, right, of a couple of days, like here, near-term decline of a couple of days, you're still there. You're still above 70. What do I always tell you guys? As long as you're above 70, the momentum, the push, the wave, the tide is with the bulls. So I still can't get excited about fighting this. I am on the lookout for topside exhaustion, you know, notorious where we are right now. Even if we do get topside exhaustion, I'm just playing a corrective move. Okay, the broader trend is still constructive. Like I said, above 120. Here's what it looks like on the daily chart, on the intraday. Okay, and here's what it looked like last night. So no change. We're just ranging in this zone. 2145 right there is resistance. The breach, again, 2230s, like we said, is that upper parallel. Remember, on the daily chart, that converges on upslope. So big level. And again, would kind of be the ideal like fairy tale trade, right? Because DXY takes that last dump, euro takes that last stretch, larger correction, and then we're off to the races again. No one's denying this is an uptrend, but it's pretty mature at this point. Questions on euro? Okay, so sterling seeing a whole lot of ridiculous price action. I hope you guys are staying careful. You know, someone in the webinar yesterday was asking me, is sterling too susceptible to headline event risk because everything that's been going on with the Brexit headlines, and is it too risky to trade? I think looking back at that question, I might have been too cavalier, but no, guys, the levels are still clean. It's happening faster. The volatility is stronger. The moves are more apparent, right? But the levels continue to play out. I'm just going to show you this simple chart. First, why are we looking for sterling exhaustion to begin with? Well, it's very simple. Here's the weekly chart, 1,000 feet up. We've been talking about 34.94. That's 2017 high week close. Pivot break saw an acceleration to the open of 2018. A pivot break again below it saw an acceleration to the downside in 2018. 2019 highs, 2020 highs. Here we are. Slope resistance. This same parallel, this same pitchfork caught the lows. So I'm paying attention here. Okay, that was 34.94. We failed there last week. What I say right into the start of this week, what was near-term support? The objective Yearly open, I said yesterday in the webinar, at 32.50. Look where we bottomed already this week. So the same exact sentence I said yesterday in the webinar is going to stand here. The immediate focus for sterling is 32.50, 34.94, period. 250 pip range. That's going to be, in my humble opinion, the validation or the guidance for our near-term directional outlook. Break to the downside, looking for a larger correction, 30.30s, okay, would be a decent level to look for a pivot. Topside breach, the Brexit gap, not really a major threshold based on that label, but certainly in price, okay? Resistance, acceleration, acceleration, that's going to be converging on the upslope. So from a weekly standpoint, wow, right? Wow. One other piece of evidence, subtle divergence. Here's what it looks like on the line chart to make this plain and simple. Higher high in price, lower high in the oscillator. Warning flag. Doesn't necessarily mean that it's going to hold, but what it does suggest that if it does buckle or it does break, man, it's going to be an accelerated shot. So as always is the case with trading, guys, you want to get into positions where if you're wrong, you're going to know when you're wrong. You're going to know you're wrong. You're going to know you're wrong quick. And these are our best sort of case scenarios. So here's sterling. Truth be told, there's already been multiple plays on this, and you know, if you got out at 32.50, good on you, really good move. Okay, here's the move, here's the failure. Okay, on Friday, here's the start of the week. We slammed into 32.50 yesterday, and then buckled right back above the monthly open, back above slope, and here we are again. So from the daily chart, messy to say the least, but things to pay attention to. Ready? More divergence into the highs, pending support trigger. You need a break below 32.50, like I said yesterday, same exact levels. You need a break of that support triggered momentum. That would be the onset for a larger correction in sterling. Is there room for a topside surprise? Some sort of good news? Oh my God, negotiations fell, have been reinstated and things look good. Sure, technically it's 35. Period! Exclamation point. That's the breakout that needs to mark resumption. Okay, sterling on the intraday. So things to look at on the weekly chart with regards to where pound is trading, things to look at on the daily chart with regards to where pound is trading today. Here's the intraday, right? So there's the slope we've been following. Came into upslope resistance, classic sterling false break throw over, right? Very, very notorious pair for these kinds of moves. But what happened subsequent? The drop right into key support. This is a basic 38.2 of the entire advance. That's 32.90, or basically looking just below the 33 handle, just above the 32 handle, excuse me, 32.09. And there's the yearly open, spike into that low. What did I tell you yesterday in the webinar? If this is going to fail, ideal scenario is 34.09, 34.18. It's the 618 drop. It's the objective weekly open. It's slope resistance. If this pitchfork is in play. Now, we added this yesterday in the webinar. We've only gotten one slick off the low there, which is pretty good, right? So I don't want to get married to this slope, but if there is some sort of down play, you know, levels of which the top side should exhaust, levels of which we should look for support essentially on a drop lower. As it stands, it's Tuesday, pretty nice weekly opening range set up right above that key zone at the yearly open support. Look for a break in sterling. Questions? All right, that is number 3. Kiwi. Here's Kiwi on the weekly charts. Precarious at the highs. You guys seen a theme here? Precarious at the highs. 2018 open 70.93, 786 retracement 71.10. perfect touch yesterday. Is that an exhaustive move for the breakout? This thing has been one of the biggest rippers, phenomenal breakout. Break of uptrend resistance last week, saw the accelerated move pop even higher. But into this zone, starting to tone my attitude, tone my appetite for the long side. Here's what it looks like on the daily. Not much to write home about. The only thing I wanted to kind of highlight on this and what I've been just, taking a gander at daily is the weekly, the monthly opening range is really tight. And not only is it tight so far, unlike Sterling and some of the other crosses, the weekly, the monthly, it keeps saying weekly, monthly opening range is taking shape right above the monthly open. So here's your monthly open at 70.13. You rallied into this key zone that we just talked about, 70.50, 70.94, right? Boom, 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 couple of days. We touched yesterday the monthly open, then rebounded again. Really tight coil near the highs. It's the same trade. It's the same trade. It's either one last spike higher, get that 50, then break down. Or if this is the spike high, kind of we need to relief a little bit back into slope resistance, former slope resistance support, then move higher. Momentum, like again, what the heck you do with that? That's not a signal. That's not a signal. So here's what it looks like on the intraday chart. The slope that we've been continuing to follow is just ridiculous. It's been phenomenal. So here's Sterling again. That resistance still holds. No change to any of those levels from last night. Here's Kiwi. Still right below, and still within the confines of this very clean upslope we've been following for weeks now. We got what would perceive to be almost a second tag of that slope here. Weekly opening range really tight now, just below that 618. Look, if we breach higher, 70.94, there's that 71.50 level, the 50% retrace. Both areas of interest for possible exhaustion if reached. Need a break below that June open, basically 70 handle to get this thing going on a more corrective stance. So all of these trades that are approaching like key resistance zones, key levels that are looking toppy, looking exhaustive, the trade may not be there yet. What we're looking for is evidence for that trend move. Once we get the evidence, then we can take a little bit more aggressive stance on trying to play the bounce back, just the pullback within the confines of the broader rally. But on the back of this move, I can't advocate for fresh long. It might still pop to 71.50, but you need to be really nimble. Dollar CAD. Here's our last dollar CAD update. We had noted last week, the whole focus into the start of last week was whether or not we were going to buckle below the objective yearly open. 29.75, 29.94 was the September low. We sat there for a while and we finally opened the week, and it was the weekly opening range high. Once the weekly range lows gave out, kept the focus lower, right? 28.84. Next level to downside was 27.78. Here's 27.78, okay? Weekly opening range is setting up just above downslope support. So I hate to say it, but the same setup. Again, if we were to dump lower a little bit, look for that slope to offer some sort of inflection, need a breach above, ideally the weekly range highs, but the whole premise of the sort of reversal play would be a breach above that 28.84 level again. So look for inflection there, but at the end of the day, it's the same trade. It's the downside looking exhaustive. Haven't gotten the reversal signal yet. Still an oversold condition on the daily chart, just like we're looking at some of those other trades on the oversold condition still. We want to see that reversal before you start to fight major downtrends. You want to see that recovery in momentum from those oversold conditions. So still on the lookout, right? Still on the lookout. Wouldn't be surprised to get a final wash lower. Keep in mind, again, you got the BOC on tap tomorrow, expected to hold interest rates at 0.25%, no change per se. but certainly the commentary is always the devil's in the details. That's number 5, Looney. Any questions on that? Okay, also from that update was SPX. I just want to show you what this looks like at this point, because it's pretty insane how clean that slope ended up being. Guys, this was published back on the 3rd. This was the gradient that we were working with. We were kind of struggling near the highs that we had made for the year at 36.74 at that region. We said if we buckled higher, look for resistance right at that upper parallel. Look what happened. We sat there for a while, popped through, upper parallel, a little ahead of schedule, but right there. And here's the pullback. So nothing really changes. You're still just pressing uptrend resistance. Here's what it looks like on the daily chart. You know, it's the same cautionary note, guys. It's the same cautionary note. Trends are in play, but trend is only 50% of the game, right? We know direction, but we're at uptrend resistance. So if there is such a thing, if not a pullback, it's going to halt the advance at least near term. And that's kind of what we're seeing for the last 5 days here at this basic slope resistance, right? Failure, kind of failure, struggling, could still rocket through. This is all fresh record highs, guys. It's all gravy from here, right? I mean, at this point, we're all, there's no previous price action to take reference off of. So it's all near term. And that's why this slope has kind of been the only thing I've been looking at for the last 2 weeks. And it's continued to serve us well. Okay. I have, well, I kind of labeled in my head near-term bullish inval. So what would validate the corrective move would be a 38.2 break of the advance off the lows that we made back here in November, because that would also necessitate a break below the median line, a break below the slope, and that would again put us on a little bit more of a corrective stance. Till we do, what do you want to do? You want to buy just pips off the record high? Nothing here yet for you if you're not already long. If you're looking for the fade, evidence is starting to mount, but it just isn't quite there yet. All right, that is number 6, SPX. Last 2 on my list, dollar yen and gold. Dollar yen is kind of a snooze fest into the start of the week. Here's what we've been looking at. Let me just take you back a step here. It's consolidation any way you look at it, from the confines of a contraction into the November range. You can even say it started back here on the October decline, but in any event, look for the breakout here. 103.70 is kind of hard line support. That's the 618 of last month's range. Let me bring that back here. And we've been stuck. You know, this thing has kind of been stuck, range bound every way you slice it. And we can try to throw on some pivots there, but at the end of the day, it's still a consolidation. So I'm looking for this breakout, hopefully into the end of this week. Breach above 105.20 is what you need to turn the whole thing around for the decline that we've been. Break, close below 103.70 opens up the spigot, I think, for the downside, and a deeper correction towards 102.40s. So I know there's a lot of lackluster trades here as we start off the week, but get used to it. Don't get too excited. We're heading into that snooze fest as we get closer to the holidays. The most important thing is that we are trading clean technically. It's just there's no momentum behind price right now. So we got a little bit more patient until we get some clarity on that. Last but not least, I'll be putting out a piece today on Daily FX for gold. This is what it's going to look like. This is kind of the first test. 2 levels that we were talking about. First, let me take a step back. Gold from the weekly standpoint looks like this, right? Right on the bat, we talked 1763, we talked 1740, both levels, which we're looking to see if can trigger some sort of pivot, some sort of low in price. Even as we were crashing through back above that 2012 high, the first level we were looking at was still 1850, 1849. We're making short order. We're pushing that now. Broader bearish inval hasn't changed for the last 2 weeks. It's still 1909. Okay. That's the weekly chart, right? Before we start to change anything for resumption of the longer term trade for gold. Here's gold on the daily. So a basic slope resistance, if you were working with this slope and he discounted this break as a false break scenario back last month, look what happened. Accelerated on the break higher, it accelerated on the break of that slope lower, and then instantly the following week was resistance again. So now that gives you a third or fourth reference point, depending on whether you want to count these. And here we are again, just higher, a basic 38.2 of the entire decline. Guess what? That 38.2 converges on the upslope. Look at the median line for this formation we've been following from the yearly lows of last year and this year. Or I'm sorry, this is the November low. Pivot, pivot, support, support, break, acceleration. That converges on the 38.2. That's 1883 over the next 3 days. That's the level, in my opinion, that would put us back on the resumptive trade. Right now, if you're holding longs on gold, again, my humble opinion, anything sub 1830, if you're holding longs, this is where you want to take a little off the table, bring your stops up to break even or better, get more defensive. Next level up, 1883. That's the big kahuna, right? That's the one we need to see a pivot, either accelerate, rip through, like we did here on the way down, like we did here on the reaction after we tested it, or failure, and we're going to get that deeper clip into 1740. It literally all hinges on what we do here over the next 3 days. All right, so here's what gold looks like on the intraday. I know this is a very messy chart, guys. I'm going to clean this up, but I just wanted to kind of highlight the levels that we've been following. Again, that red slope is what we're looking at on the daily chart. Here we are. That median line, this is the formation that we were following from a scalp perspective. The break, acceleration on the way down. Whoops. Just ahead of that 1763, acceleration on the break on the way up. There's the median line. So I kind of don't want to remove it. I know this looks messy. For all intents and purposes, focus on this from a scalping perspective. And let's see what kind of reaction we get. 1883 is the real tell. All right. Going once, going twice. That is gold. Okay, guys, that's everything that's on my list. I flew through this today. Let me know if you guys have any other questions or trade setups you'd like to review. If the volatility has got you down, guys, don't worry about it. Again, things are setting up pretty nice, and there's a lot of event risk on tap. So the big movers, as it were, are kind of the ones that you're most mindful of right now because they're pretty stretched, and the weekly opening ranges have set up pretty tight. So I do think we get some decent plays later in the week. Stay primed, specifically heading into Thursday. We'll talk again Thursday morning, but I think those GDP figures out of the UK and the ECB is kind of going to give us the play that we're looking for on these Euro block to get some of these moves that we're looking on the majors. All right, so guys, I'll wrap it up there. Best of luck trading, and I will see you guys all on Thursday. Cheers.